asset allocation is a big driver of returns. But how have you managed to make some big calls, or what are some of the big asset allocation calls that you've made within your balanced portfolios?
Okay, well, let's take the stable fund. When we started up about 11 years ago, the big call was to be in property, because property earnings were rising, and it's likely to be a great way to get the inflation plus 4 target. And we bought a lot there. The flows to the fund came in and diluted that a bit, but we were actually aiming to get up to about 35% in property in that period. And then the valuation became full, and we only got up to about 18-20%, I think it was. And then that came down. And about 2 years ago, 2.5 years ago, we felt that the local property was expensive and was going to hit headwinds. We didn't like the way the economy was growing. So we've downweighted local listed property to less than 2% from that 18% plus level. We've got a little bit of property in listed foreign, got that right down. And the other big change that we had, we didn't like bonds. We felt interest rates were likely to be rising, etc. And from 18 months ago, we started buying an R186, and you can see the weighting as different fund managers bought into the safety of getting CPI plus 4 with a 186. You're buying it at 9%. It's got a very high coupon of 10.5%. With inflation unlikely to go above 6 for very long, you're locking in 3. If inflation is going to be 5, you're locking in CPI plus 4, which is the benchmark. And the 186 was a 10-year bond at the time, and because of the normal curve, by the time we get to 5 years' time, it'll be on the waterfall of the interest rate curve, and you'll start to get some capital appreciation there. So you probably pick up 50 to 125 basis points of capital appreciation as it comes down the waterfall of the curve. So there we've got CPI plus 4 to 6% in a 186, and that's stabilizing the stable fund.
Right.
And that's part of the money that we can't put in equities, because in the stable fund we can only allocate 40% to equities. So there's 2 big asset allocation changes that we've made within the stable fund over the period we've had it. So we don't find a neutral level and then just stick to that asset allocation level. We do move the asset allocation a lot.
Right.
And in terms of equities, or even though only 40% in equities, we moved our equity allocation down to 35% by taking 5% off the local equity allocation in the fund, which is quite a big call. And we see that as like 12.5% extra cash for equities in the stable fund. So we do walk the talk and implement big asset allocation change.
You've added a couple of longer dated SA government bonds recently. Does that push the duration out?
It does, not much though. It's not many. In terms of weight, it's 2%. It's not material yet, but at the right time, if we think interest rates are going to be coming down, we'll lengthen the duration. But it's not our positioning at the moment.
And at the moment, moves on the of the central bank aren't going to have a big impact on your current fixed income portfolio.
Well, what are the moves on the central bank? A lot of people have been expecting interest rate rises locally. And in this sort of weak economy, it's just not going to happen in a big way.
Right.
So looking after the rand is part of the reason for pushing rates up. But we already have high real rates here. So fighting the old war is what the central bank's been about, and worrying about the impact on inflation of the currency and trying to push interest rates up to hold that. But with high real rates already, it's already doing that, which is why our inflation rate is now 5% and not 7 or 8%.
Right.
So the high real rate has had that impact already. So most of it's already in the market. They don't need to push the rates up anymore. But the weak economy is already having impact on the current account, dropping imports, which it normally does in that cycle. So we're well through the cycle in terms of having high rates. We more need to be looking at when rates are going to be dropping.
Right.
And we're fortunate that we've got these high real rates here at the moment that we can invest in and protect ourselves against inflation.
Yeah.
And that's a good thing. The rand is also determined a bit by the dollar, and I think the dollar is in its 9th innings, and from here the dollar is likely to weaken. And from time to time there'll be rallies in the rand as the international investors, particularly the asset allocators, move out of dollars and into emerging market currencies and markets, and they'll need to buy the rand for that. So there's some inflows will start as people start to buy the emerging markets on an asset allocation basis, right, and ETFs and things like that. Generally, we've got a long-term view that the rand will be a weak currency because the government's spending 5% more per annum than it's earning, and you've still got the SOE problems, which were hidden a while ago and are now more obvious. Mm-hmm. The debt that's coming in from Eskom, etc., SAA, that still needs to be sorted out. So the lack of efficiency here also will determine that the currency will be generally weak in the longer term, but in the short term you might see some flurries of strength in the rand. So I don't see in the short term that they will need to increase interest rates. So the bigger risk is that interest rates fall. If interest rates rise, we've got the coupons coming in and we've got a fair amount of cash and we'll get high interest rates. That's great.
You've locked into those rates.
That's a good one. But if rates fall and you haven't got the bonds, right, then you're going to miss the opportunity. So the bigger risk is that if interest rates fall. Not that we expect interest rates to fall that much either. So it's more in a steady as we go situation. Right. But my guess is that we're more likely to see a 1% cut in interest rates over the next 18 months than a 1% increase in rates. Right. And that's a bigger risk for investors.
Yeah. And the exposure to global markets is generally being kept at the limit within the stable fund because it's a more diverse universe of opportunity, correct?
Partly so. There's a much bigger weighting in the Foord International Trust than there is in the Global Equity Fund. And the Foord International Trust is only 63% in equities, but 8% of that are utilities, which are more bond-like. So they fit into the bigger picture as equities. They make up to 63, but 8% are in utilities, which are more bond-like, and their earnings are there, and they on yields of 7 and 8% now because they got marked down because of Brexit. Right. So we diversified there, and we've got a little bit of a Brexit hiccup on them, but the yields are fantastic, the yields are safe. So whilst it looks on the surface we've got 63% in equities, I'm treating it as 55. But even at the 63, you can see we're not at full equity position on our international side either.
And then the last component of the portfolio that some people question is the gold exposure.
Yeah.
What's the purpose of that within?
Gold in the stable fund, and we have it in the Foord International Trust, is an insurance position. And insurance policies you don't want to claim on. Right. So we'd like it that gold doesn't necessarily do too much, but if there's systemic issues, then gold will do well, as we've seen in the past. And right now, with the dollar in its 9th innings, gold will perform, it's a hedge against the dollar. So all fiat currencies go to naught eventually in the world. Even the dollar, it's a fiat currency now since it's gone off the gold standard. Is the euro going to strengthen? Probably not. Is the yen going to strengthen? Probably not. So now, if the dollar is going to weaken, what currency can it weaken against? Well, the one it's going to weaken the most against is gold. So the gold position is partly insurance, on systemic reasons. It's also a hedge against the dollar because a lot of our assets are priced in dollars. So we need a bit of a diversification and management of dollar risk, and that's why the gold position is there. Not because we've gold bugs and we really like gold. We think gold will be a good performing asset in 2019.